Stop scrolling because I am about to show you how the IRS accidentally created a legal money glitch that lets you dodge taxes 3 times on the same dollar, and almost nobody is using it correctly. I am not joking. This one account lets you get a tax break when you put money in, lets that money grow with 0 taxes, and then lets you pull it out with 0 taxes again. It beats a Roth IRA, it beats a traditional IRA, it beats a 401k, and if you're a micro business owner, freelancer, side hustler, Etsy seller, Uber driver, landscaper, online coach, whatever you do to make your own money in America, this account also lets you dodge Social Security and Medicare taxes, which is an extra 7.65% to the W-2 employees can never get back. And the wildest part, less than 10% of eligible Americans actually use this thing the right way. The rest are using a Ferrari to deliver pizzas. They swipe it for copays and think they are winning, while the rich let it quietly turn into a $500,000 tax-free retirement vault. I am talking about the HSA, the health savings account. But forget the name, it is not a health account. It is a secret retirement account in disguise. And today I'm going to show you exactly how to hack it before the government wakes up and closes the loophole. Let me tell you about 2 friends who did everything almost the same, but ended up with wildly different bank accounts. Both 30, both make about 80 grand a year running their own micro businesses in Texas. Jake is a good dude, works hard, listens to mainstream finance advice. He maxes his Roth IRA every year, pays taxes on that money now, and thinks he will be tax-free later. He feels responsible. Maya does something weird. She picks a high-deductible health plan, opens an HSA, maxes it, invests every dollar into a total market index fund, and then never touches it. She gets a cold, pays cash. Her kid needs glasses, pays cash. She throws every medical receipt into a Google Drive folder like a total nerd and just lets the HSA cook. Fast forward 35 years, they are both 65. Jake has around $800,000 in his Roth. Solid, respectable. Maya has over $1.1 million combined because she did the Roth and the HSA, but here's where it gets savage. Maya paid about $150,000 less in taxes during her working years because her HSA contributions lowered her taxable income every single year, and she still has a shoebox with $90,000 worth of old medical receipts that she can cash out completely tax-free whenever she wants. No penalty, no tax, just straight cash. Jake is staring at her like, girl, how did you legally rob the IRS? The answer is simple. Maya understood the triple tax advantage, and Jake thought HSA stood for how to spend for Advil. If you are a micro business owner in the United States, this story should make you a little angry in a good way. Because nobody in school taught you this. Your payroll company did not teach you this. Even a lot of CPAs who work with big corporations do not explain this to small guys because they think you will not get it, but you will get it right now. Let us break down why this thing is called triple tax advantage and why it is literally the only account in the whole U.S. tax code that does all 3. Number 1, you get a tax deduction going in. Every dollar you put into your HSA lowers your federal taxable income. If you put in $4,000 and you are in the 22% bracket, you just saved $880 instantly. That is not a credit. That is cold, hard cash you keep. If you run an S Corp or you are self-employed and you run it through payroll correctly, you also skip FICA taxes. That is Social Security and Medicare. That is another 7.65% on top. So you are saving almost 30% off the top before the money even starts growing. Show me a Roth that does that. You cannot. Number 2, your money grows tax-free in the middle. No taxes on dividends, no taxes on interest, no taxes on capital gains. In a normal brokerage account, you would be losing 15 to 20% of your growth every year to taxes. In the HSA, you keep it all. That difference over 30 years is not small, it is life-changing. It is the difference between retiring at 65 and retiring at 55. Compound interest without tax drag is like driving downhill with a tailwind. Everything is just faster. Number 3, you pull money out tax-free at the end if you use it for qualified medical expenses. And qualified is way broader than you think. We are talking doctor visits, dentist, orthodontics, vision, contacts, glasses, therapy, mental health counseling, chiropractic prescriptions, lab work, surgery, breast pump, sunscreen that is SPF 15 or higher, first aid supplies, even tampons and pads now count. If you are a stressed out micro business owner with back pain from sitting at a laptop all day, guess what? That stuff probably qualifies too. So you get a deduction going in, tax-free growth, and tax-free money coming out. No other account in America does that. Traditional IRA gives you 1 and 2, but taxes you on the way out. Roth gives you 2 and 3, but taxes you on the way in. HSA says, why not all 3? It is the unicorn account, and the IRS left the gate open. Now here are the 5 brutal mistakes that are costing regular Americans hundreds of thousands of dollars because they do not understand how to actually use this thing. Mistake number 1. People treat it like a spending account. This is the biggest L. They put money in and then immediately swipe the HSA debit card for every little copay. That is like planting an apple tree and then ripping it out every week to check if the roots are growing. If you can afford to pay small medical bills out of pocket, do it. Let the HSA money stay invested and grow. There's no time limit on reimbursing yourself. You can pay for something today and reimburse yourself in 30 years, and it is still tax-free as long as you kept the receipt and the HSA was open when the expense happened. This receipt time travel trick is completely completely legal, and almost nobody talks about it. Mistake number 2, people leave their HSA in cash. This one makes me want to throw my laptop. If your HSA is sitting in cash earning 0.1% while inflation is eating 3% a year, you are literally losing money safely. You would not leave your Roth IRA in cash for 30 years, so why would you do it with your best account? Most HSA providers let you invest once you have about $1,000 in cash, move the rest into a low-cost S&P 500 or total market index fund and leave it alone. A 35-year-old who maxes a family HSA and invests it instead of leaving it in cash could have over $500,000 more by age 65. Same contributions, same account, totally different life. Cash is not safe. It is slow death by inflation. Mistake number 3, people think they do not qualify because high deductible sounds scary. Listen, high deductible health plan sounds like a scam, but do the math. For 2026 in America, the IRS definition is roughly a $1,600 deductible for an individual and $3,200 for a family. That is it. A lot of plans for entrepreneurs already hit that, and the premium savings are insane. A low deductible plan might cost you $700 a month for a family. That is $8,400 a year just in premiums before you even use it. A high deductible plan might be $400 a month. That is $4,800 a year. You just save $3,600 a year in premiums. Even if you hit your deductible, you often break even or win, plus you unlock the HSA Superpower. Do not pick a plan because the word low feels cozy. Cozy is expensive. Mistake number 4, people think it is only for themselves. Nope. If you have a family HSA, you can use it for your spouse, your kids, and even your dependent parents' medical expenses, even if they are not on your high deductible plan. Your daughter needs braces that cost $6,000, boom, tax-free. Your husband needs LASIK, boom, tax-free. It is a family medical vault. One account can cover a whole household, and every dollar you pull is tax-free if it is for their qualified expenses. Mistake number 5, people do not know about the age 65 Superpower. This is the final boss hack. Before 65, if you take money out for non-medical stuff, you get slapped with a 20% penalty plus income tax. Do not do that. After 65, that 20% penalty disappears forever. After 65, your HSA basically becomes a traditional IRA clone. You can pull money out for anything, vacations, rent, groceries, a new truck for your business, whatever you want, and you just pay regular income tax like a 401k. But if you use it for medical expenses, it is still 100% tax-free, so you literally cannot lose. Either you use it tax-free for healthcare, which you will definitely have a lot of in retirement. Fidelity says the average 65-year-old couple needs around $300,000 just for healthcare and retirement, or you use it like a regular retirement account with no penalty. There is no bad outcome if you let it grow. So here's the savage, simple playbook I give every micro business owner who will actually listen. Step 1, see if you can get a high deductible health plan that qualifies. If you are relatively healthy and you do not go to the doctor every month, you probably can and should. Step 2, open an HSA with a provider that does not suck. I love Fidelity because it has 0 fees and lets you invest everything with no minimum. Lively is also solid. Do not stay with your employer's crappy HSA that charges monthly fees and forces you to keep $2,000 in cash. Step 3, automate max contributions. For 2026, we are talking about roughly $4,300 for individual coverage and $8,550 for family, plus an extra $1,000 if you are 55 or older. If you and your spouse are both 55 plus and you both have your own HSAs, you each get your own $1,000 catch-up. That is an extra $2,000 most couples leave on the table. Step 4, invest it aggressively and forget it. Keep maybe $1,000 in cash if it helps you sleep. Invest the rest in a total market index fund. Do not try to day trade your HSA. This is not crypto. This is future you money. Step 5, pay medical bills out of pocket if you can afford to, and digitally hoard every receipt forever. Snap a pic, upload to a folder called Tax-Free Money Vault, back it up twice. Future, you can reimburse yourself any amount at any time tax-free as long as you have that proof. Do that for 20 years while you are building your micro business, and you will lap 90% of Americans who are still arguing about whether a Roth or traditional IRA is better while you have both beat. Now think of it like this analogy that finally made it click for my audience. A traditional IRA is like the government gives you free seeds but wants a cut of your harvest later. A Roth IRA is like you buy your own seeds but you keep the whole harvest. The HSA is like the government gives you free seeds, gives you free fertilizer, and then says keep the whole harvest if you get a little sick while harvesting. It is just a better deal. Look, as a micro business owner, you do not get a fancy benefits department to set this up for you. You have to be your own CFO. The rich have whole teams finding these loopholes. This one loophole is sitting in plain sight, and you do not need a lawyer. You do not need an offshore account. You just need to open the right account and stop using it like a debit card. So here is the question I want to start a war over in the comments. Respectfully, of course. If the HSA is objectively the best retirement account in America because of the triple tax advantage, why do most financial gurus still tell young, healthy entrepreneurs to max their Roth first and ignore the HSA? Are they just outdated? Are they scared to explain high deductible plans? Or is there some secret downside I am missing that that makes the Roth actually smarter? Drop your take below. Team HSA first or Team Roth first? And tell me why I'm wrong. I read every comment, and I will debate you. And if this made your brain light up, smash that subscribe button, because next video we are getting messy. We are talking divorce and money. Who gets what? Who gets the business you bled to build? Who gets the house? Who gets the retirement accounts you just learned how to hack? How hidden crypto gets found in court? How alimony can wreck a microbusiness owner? And how a simple piece of paper could have saved you hundreds of thousands. It is high drama, high legal CPM, high stakes, and every entrepreneur needs to hear it before it is too late. You do not want to miss it. I will see you in the next one.